So I'm always going to look at it because there's new ways of thinking, there's new technologies, there's new information that comes, and we want to be able to adjust and iterate on that.
My name is Matt Reiner, managing partner at Capital Investment Advisor, CEO of Wellness Strategies, an author, podcast host, and also a speaker to the wealth management community. My mission is to help every family in this country have access and be served by a human financial advisor. That we all have to live in the moment and not try to force progress too quickly. Let it happen and commit to a long-term strategy in your life, in your business, and in your investment portfolio.
And now, your host and my dad, Matt Reiner.
Rich Gill, Wealth Partners Capital Group. How are you, my friend?
I'm good, Matt. How you doing?
I can't complain, man. It's a day in paradise. Every day is. But I'm so grateful for you joining us. I can't wait to learn from you. As I told you kind of as we were before recording, like this is a selfish podcast because I do this to interview really cool people and learn from them all around the FutureProof Advisor. As we talked about mind, leverage, and innovation, right? Have the right mindset, create leverage, and then you can just go and explore and innovate. So you have such a different perspective that I am just intrigued by. So I can't wait to dive into it. We'll talk about everything from perspectives. We'll talk about the future of the industry, and then we'll talk about how we can go beyond wealth as well as we talk about the future of the industry. But before we dive into all of this, I'd like to get on like a personal level because this is a conversation and we need to be on a personal level. So, what did the 13-year-old Rich Gill want to be when he grew up?
I'm not even sure what the 13-year-old Rich. I mean, it probably oscillated between maybe one day turning into someone girls would like to date, and then the next day an astronaut. So a vision as a future of a wealth management investor had not yet materialized at 13, but I like math, and I was sort of learning about what I was good at. I loved reading books. I didn't always like school, but I enjoyed some aspects of the academic experience. And so I think I was still in development at 13.
Yeah. I think I'm still, even though I'm married, I'm still trying to be that person that someone wants to date. I don't know how I stumbled upon my wife. So I think that's a lifelong journey is what I'm telling myself to navigate through this. But tell me then how it goes from wanting to be an astronaut, kind of liking school, liking books, liking math, to now you invest in some of the largest wealth management firms in the country.
So my path to wealth management was a little bit winding, as I think many of ours have been. I was working at a private equity firm called Silver Lake Partners, a big LBO shop. And it's the sort of place where you work a lot. And I was, sleeping under my desk and doing all the things you do as a young professional trying to make your way in the world. And that worked for a year because my wife was doing her PhD and was away. And so we just didn't see each other for a year. Then it was fine. She came back, and after about 2 months, she said, okay, it's been 60 days and I've seen you 4 of them. So you are going to need to make a choice. You can have that job or you can have this relationship. Let me know. Fair enough. They were great. They said, we understand. It happens. What are you interested in? Ameritrade was one of the portfolio companies of Silver Lake. And I had been interested in that. And they said, well, you like that business, but you want to stay in San Francisco. Let us introduce you to Schwab. Shortly thereafter, I'm working in the strategy and corp dev groups at Schwab, which is where I figured out what an RIA was. Before that, I had no idea. And I started to learn the custody business and all its kind of complexities and intricacies. And about 3 years after joining Schwab, I ended up getting connected with this little startup, and that was Focus Financial Partners. So I joined Focus as its second employee, and every other week I'd fly to New York and sit on Rudy's couch with Mike Paley, the one other employee who was there at the time. And we would be working on models and deals, and Rudy's kids would come home from school. And it was a lot of fun. When I joined Focus was $3 million in revenue. And when I left, what was it, 7 or 8 years later, it was almost 300 million in EBITDA. And it was a decentralized model. And so I had a view of all these different portfolio companies, and they all needed different things. And I was having all these conversations. And that was kind of a way I went from learning not just how to be an investor in an RIA, but what is an RIA? What is its DNA? How does it work? Then I went to, I'm giving this whole resume here. Feel free to cut me off anytime. I went to AMG, where we invested. They were an investor in big long only asset managers, and were interested in investing in some RIAs. And that was another good perspective. It also taught me a lot about what it means to be a public company and what it means to try and make investments and decisions in a public company. So I learned a lot at AMG. And then John and I started Wealth Partners, and the full name is, of course, Wealth Partners Capital Group in June of 2017.
That's incredible. So, I mean, there's so much from that. I mean, that journey, I love it. I mean, it shows your natural inclination of learning. Each step you highlighted different learning lessons. And that just goes to someone that has as I call it, the future-proof mindset of just understanding that each step is another step of learning. That's what it's all about. You know, something that you mentioned through the focus days that I'm curious to dive into is you said you learned what the DNA of an RIA was. I'm curious. So what is the DNA of an RIA today? And is that different than what you had as the DNA of an RIA in your days at Focus?
Yeah, I would tell you the whole industry has matured. You know, when I was at Schwab, a big firm was 300 million. If you're 300 million today, I don't even know if you get your phone call returned, right? And that, what was 300 million then in terms of scale, I would argue it's probably 3 billion now, and that's going up. So my answer then, which still matters, but is sort of necessary but not sufficient, has to do with the relationships. The relationships the lead advisor or advisors have with the client, that's the first part of the DNA of an RIA. The second part is the staff that you build in order to support those relationships and how you look at it. And that can look all sorts of different ways. You can have one broker who leaves and starts his or her own firm and have 3 CSAs and serve $300 million. That's one type of firm. You can also have a firm that really operates like a business at 800 million and, you know, has an actual org chart and thinks about funding and has a real cap table and thinks generationally. And so I think it starts with those relationships, but as you pass certain inflection points in the industry, the answer has to change. And below 300 million, you can run your business any which way you want. It doesn't matter. It can be out of mom's basement, or it can be a one-person show with everything outsourced, or it can be heavily overstaffed with no margin. But once you get over $1 billion, you just can't do that stuff anymore. If you're going to grow and have your business stick around and survive, you have to have standardized practices. You have to have some workflows. They have to be written down. They have to be repeated. You're going to need an org chart. You're going to have role clarity. There's going to need to be somebody who does operations. The people running the firm are going to have to make some decisions. Am I an advisor or am I a manager? Because running around trying to do both is a recipe for sort of plateauing as a firm. And if you're going to keep growing and continue to do those things, it means investing in your own firm.
It's the risk taker's mindset. You've got to be able to take that risk and know that not all of them are going to work, but you've got to have some understanding of it. I think, you know, it's really interesting whether what you defined as the threshold of kind of, you know, sub-billion to above a billion, you have to change. I'm curious in that transition. Change is not a desirable thing of anybody. And if you think about firms that get to a billion, they're usually, if I were to paint the picture, at least from my belief, is that it's usually the founders still involved. They're the rainmaker. The founders, they're still involved. They're the rainmaker. They've been growing it kind of just because they're just really good at growing and managing and building, but maybe not managing, just building relationships. They now shift to a billion, and like this thing switches, and you've got to now make these decisions where, to your point, are you an advisor? Are you a manager? Are you a leader? Are you a doer? Like, where are you in that realm? That is a difficult transition. So as people are having to navigate that decision, whether it's at a billion or sometimes it could be at 500 million, or 2 billion, whatever it is, it's hard because you have to give up your baby that you built. And you have to understand that things don't move linearly. What got you here won't get you there. How have you seen people, the most successful people, alter their mindsets to overcome that period of transition?
There are many ways to be unsuccessful. There aren't that many ways to be successful in this. And by way of example, we've been working with EP Wealth Advisor since 2017. And when we showed up, they have two founders, Derek and Brian, who built the business. They're fabulous advisors. And to their enormous credit, I'd love to take credit for this and say it was all my ideas. Absolutely wasn't. They did this before we ever showed up. They looked in the mirror and said, we're not CEO material. We don't want that job, and we don't think we'd be good at it. And so as a result, we're not going to be CEO. We're going to go find one. EP has been successful for a bunch of reasons, but that's one of the main ones. Early on, these guys put aside ego, and I think that's a hard thing to do, and said, it's not the best role for the two of us. We're founders. We might own most of the business. It's our baby. We've built this thing from scratch, and we're, paying for rent with credit cards early on. But it's just not the right thing for the business for us to be in that seat. And that's a hard thing to do. And I think many are not able to do it. Most firms plateau, and they plateau because wealth management is a terrific business, and it's possible to earn a wonderful income with great work-life balance if you're pretty good at this job. Good for them, man. That's great. For the ones who really want to build something, there's going to have to be a give up, a change of that Derek and Brian type at some point, or they're going to hit a ceiling.
There is this balance that's super interesting to be found in the most successful entrepreneurs or leaders. It's not even many leaders of large organizations are entrepreneurial minded. Maybe they didn't start their own thing, but they're entrepreneurial minded. Is that there's this balance that you have to have this ability to have the confidence in self, but the awareness of reality, in the sense of you have to be able to look forward and know that, and be okay by still being confident that what got you to where you are, yes, you did a great job, won't necessarily get you where you are, and that's okay. Job well done. Now move on.
And I would also say, if you're doing some sort of self-appraisal and you think you're doing really well at everything, then you got to go a little deeper on the appraisal.
Well, I mean, I've done mine pretty deep, and I feel I'm pretty top notch across the board. I mean, I don't know, but it's like a unicorn, Rich. I mean, you get it.
But I mean, you reference the other area where this stuff really comes up is when you have internal succession. So now you have ego, and you may or may not have family, and you have these big challenges where people are thinking about their career, they're thinking about what it means, they're thinking about the mortality, and that's before you get into the money. And so those situations are hard. And once again, you look at what the business needs and you say, okay, I'm 75 or whatever it is. What's the right role for me? What needs to happen for the business? What's fair? What's next? That's another one where firms really get stuck.
Yeah, they struggle with it because they think that they can do it forever. But the reality is they may be able to serve families forever, but that's different than running a business forever. And like, I mean, we're talking the week after Warren Buffett shareholders meeting, he came out and said he's retired, 94. I mean, you just can't do it all forever, and you've got to have that. You just got to have that ability to say, I've done a great job. Now it's on to someone else. And you have to invest in them early and build them up. It's a hard thing to do, to let go of reins of something you built, but you've got to get there at some point. And I think that it also, to your point, right, being out of touch, and this kind of shifts a little bit of the conversation as well. I think that there's this aspect of ego and being out of touch or inability to see what the future holds creates disruption in your own business. And I think about it in the sense of like, if you think that what you're doing is the best thing since sliced bread, and you think that everything else that everybody else is doing means nothing, then you're going to get passed eventually, because that's just not the reality. And so I'm curious, to your standpoint, as you talk to these firms that you work with or that you're going after, like, how do you think about innovation within our business, today and into the future? How do you think about innovation?
If you interviewed people who were in the wealth management field in the 80s and 90s, they would probably be talking to you about picking stocks and creating alpha. And that's not our industry anymore. Our industry today is much more oriented towards, how are your parents doing? Let's talk about saving for your kids. Have you thought about long-term care? How long do you want to work? Those planning conversations define our industry, not, is it Coke or Pepsi or whatever? Whichever stock should I pick? And in that planning world, it's a talent conversation. So how do you attract talent? How do you train? How do you grow? How do you bring people over? Well, you have to run your organization in a certain way to attract talent. And if it's your personal fiefdom and you have 3 people and it's your rules, not that many people are going to be attracted to it. It's going to be really difficult to get people. But if you can build something that's robust and has a comprehensible actual structure and org chart and a way of doing things and a high quality work product across its offices, it's going to be easier to attract talent. The other thing is, you do have to grow. If you lifestyle a business, what on earth are you going to pitch the highly talented 35-year-old? What are you offering them? Is comp going to go up? Why? Why would we make more money in 3 years than we make now? We don't add clients. And so the equity exchange kind of becomes a zero-sum game. So you need growth to get the talent. And then when you plateau, and this is one of the things I think firms don't always understand. Well, we have this great firm and we've grown up here. And now, I don't know if we want to invest another $1 million into our business. Well, what are you going to look like in 5 years? Are your best people still going to be there? And if so, why?
Yeah, stagnation is the ideal. I mean, growth is the currency, and you have to continue to invest in growth. And I want to go the talent hungry angle for a second, and then I'll come back to the growth angle, because I think growth is a major topic. Talent hungry. I think that even firms, I mean, hell, we're growing rapidly, and it's still really hard for us to find talent. We've got a great culture, we've got great growth, we've got the org and everything, and it's still really hard. And I'm sure you're seeing it with other larger firms as well. I mean, I don't know. I don't believe all the data I hear. Some of it's good, some of it's not. But like, there's 130,000 jobs that we're not going to be able to fill by 2030 in the industry. I don't know what it is, but I don't even care what it is. But what solves this talent hungry problem? How do we make it more attractive for people to come here?
So ultimately, you have to grow new advisors.
You have to go and recruit young talent and grow them yourself. So you basically have to invest in a farm system.
The industry over time needs to do that. It just needs to grow more advisors. And look, 10 years ago, you didn't have college programs and planning. Now you do. The market is self-correcting, but it's slow. You tell me, you're in the seat, how long does it take to train an advisor from a 22-year-old college grad to capable?
Well, that's the problem. That's the challenge. That's why I think there's technology that has to help with it. But that's the problem, because it's not the number of years that you have of experience. It's the number of cycles you've experienced. And you can't force people to go through a 2007, 2008 time period and learn in that period, or a 2020 period. Like, you've got to go through those to learn how to deal with emotional people. And I think that becomes the challenge, which is one of the reasons I'm so big on VR, but we're not going to go down that path. But it's such a hard thing to do because they can't be ready enough soon enough right now.
Yeah. I mean, I would say it's a minimum of 5 years.
Yeah.
And
a minimum, 100%.
A minimum. I think it's very rare you see people client ready in fewer than 5 years. And, it's interesting. You raised innovation earlier, and there are places where I think we've seen great innovation, and there are places where we've seen it not work. And what is a wealth management firm? At the end of the day, today, we can talk about why this might not be the case in 20 years, but today, it's a person sitting across from you that you trust, that is helping you figure out this complicated money stuff, which is a top 3 source of anxiety in every American, and probably every person on the planet to some degree, but certainly every American, and helping you feel better about wherever you are with your financial situation. That's what an advisor is. And there was a big effort to try and disintermediate the advisor, right? Do you remember the rise of the robos? We had Betterment and Personal Capital and all these things. They raised $700 million in venture capital. And the idea was you don't need this human dummy, right? The computer's better. It would be AI now. And let's get rid of the people, and then we can charge less. Because, at the end of the day, that advisor is just throwing the client into a model portfolio anyway. So that business either underperformed or failed, depending on your point of view, from a venture capital returns expectations, total failure. And I think the reason is it misunderstood what the advisor is supposed to do, right? The goal of the advisor is not a conduit to get the client into model portfolios. The model portfolios aren't what matters. What matters is the trust, is the relationship between the two people sitting across from each other. Wealth management is a personal relationship. That's all it is. Everything else it is window dressing. But when you get back to talent, that's what you're looking for, and that's what you're trying to train. It helps if you start with high EQ people, but you have to, and there's a technical dimension to the training. You have to know enough about the different account types and tax structures and this and that in order to do the job competently. But yeah, you need enough reps to be able to build trust with someone across from you.
It's a matter of who you're looking for, because I think where technology and innovation play is helping to provide the tools and the resources to people that have high EQ to go and have that technical capability, but they have that EQ ability, which is harder to train, right? And if you can merge that, that's where innovation is. It's not to replace the human. I mean, I did a nationwide survey a nationwide study of affluent Americans that had above $100,000 of investable assets across America. Some had advisors, some didn't. Overwhelmingly, greater than 90% of them said that the human adds more value than technology. So the human is not going away. But here's the thing. Their number one primary goal was saving for retirement. Number 2 was financial freedom. Financial freedom. That is not tactical, data-driven, technical. That is emotional, feeling-oriented, behavioral. And that is them. That is the nation, affluent Americans. And this was across wealth spectrums, $1 million or more, Gen X. It was across spectrums. It's what they're trying to tell you is that they need more touchy-feely feeling stuff, but they don't know how to tell you because they don't know how to judge it. So they just say, help me save for retirement. But they don't value gains. They value connection, and they value that going deeper and helping them find different things like purpose and everything of that nature. And so it's such an interesting dynamic. And when I then think about, growth, which we talked about, right? That is the holy grail. It's the necessity and the number one. And I think that that's a challenge as well for firms and challenge with the people that they hire. Growing is challenging. And so I'm curious from your standpoint, like if we want to shift to this conversation, why is growth so hard for firms?
Well, I think there's a couple of things. It's not up to a point. So one of the non-negotiable scale ceilings in our industry is the number of clients an advisor can serve. And we might have different views. You might say it's 250. I might say it's 50. It actually doesn't matter what the number is. There is some number, and you can't take any more clients above that number and do a good job. There's a ceiling on it. So if you have a firm with a sole principal, and it's essentially a sole proprietorship or with 2 or 3 employees, it's pretty easy to grow up to your capacity level. You don't have to change anything. You don't have to do anything. That's simple, right? And then you're at 300 million, 400 million, 500 million, wherever you are in terms of assets. But then you're done. So now you have to hire another advisor. But that advisor needs a support structure, and they want certain things in terms of the technology that you might not have. And they're going to want to be an equity owner because it's a small business. And you have to make a whole series of decisions that are very different. And a fair number of people hit the ceiling and stop. So growth across RIAs it is this kind of flat pyramid where at each of these inflection points, a whole bunch of firms just stop. Now, they'll still grow quantitatively because the market goes up on average, but they're not really growing in any meaningful way because they're not adding clients and their firm isn't expanding in any of the traditional senses we talk about when we talk about with business growth. And at each inflection point, the number of corporate changes, the level of transformation becomes more demanding.
So talk to me. So let's talk about that and you made a mention of it a few times. I think that a lot of people are sitting there and hearing the sense of to grow, you have to invest money. And so these firms that are stalled, but are really eager to grow, you're telling them, they come to you and they say, Rich, you know what? I heard you on the FutureProof Advisor podcast because I listen to it every week because I love Matt Reiner. They're like, I want to grow. You told me to invest money. I'm ready to invest money. Give me a game plan to invest this money. Do I go do digital advertising? What am I doing to grow, Rich, if I'm ready to invest my money?
It's a good question. How did you get to where you are? Is the next answer.
I've run out of all my referrals. I've run out of all my COIs. I've tapped my market. Now what do I need to do, Rich?
Well, so it's 2 things. So one part of growth is new clients coming in the door. So for a firm to grow, that has to happen reliably and predictably. If that's happening, whatever it is, you're going to add 100 clients this year and you're going to add 100 clients next year. That's going to add $1 million of revenue to your firm. Great. Wonderful. But now you're going to see in the business, you're starting to bump up against some issues. Who's going to serve the clients? How are you doing on advisory capacity? Who's onboarding all these clients? Who's getting their performance history over? Who's getting everything locked into your systems? Who's setting up their quarterly reports? Is that working well? Because having clients frustrated with their onboarding experience is not good. Who's managing custodial issues, right? Matt was going to join me and he was moving his money, but there's a problem. The custodian was hung up for 2 weeks. Well, that's not acceptable. So the investment is going into making sure the clients are served and your infrastructure can handle bringing them on. That's where the money's going. What we often see, especially with RIAs, is they hire in arrears, meaning they wait for the problem. Oh my God, we got hacked. I need a head of IT. Well, that's not great if you're trying to be a growth firm. If you're trying to be a growth firm, then you need to hire in advance. And unfortunately, that means you're spending the money before the revenue comes in. So what you make is just shrinking. And that's the investment side of it.
Yeah. Yeah. I think there's that makes complete sense. It's a time-focused strategic aspect to also an investment into what's needed to serve that anticipatory growth. You have to invest in yourself to say that what I do on this strategy side and time side is going to lead to actual new families or clients side And that's what I'm going to invest in, is on that, people. It's not, I think that too many people think that the spending money aspect is on the strategy side. Like, I'm going to go buy more ads and stuff like that. And I think that that's where people get lost, because it's not that. It's a time focused thing on getting the families. The investment thing is on serving the families the right way and making that aspect. And also on investing in people to create you the leverage and the time to allow you to go do the strategy aspect, which is necessary in that side. Before I get to, I want to wrap up here shortly. I mean, we could talk for hours, Rich. This has been super fun and intriguing as well. You know, and when we talked earlier,
So what it ultimately means in my mind is, do the clients feel good about where they are with the money, right? And if we think about it, anxiety is an expression of concern that you're not doing something about, right? And so if the planning, look, if the person has $4 in the bank, planning doesn't matter. That's a different problem. But for the person who's fortunate enough to have whatever it is, 100 grand in the bank, fine. You can help that person with planning. You can help them think about their lives and understand what they can expect their money to look like given reasonable rates of return and volatility and all these other things. And understand you're going to be able to pay this much for your kid's education. This is what it's going to mean for elder care. If somebody gets sick, this is what you do. You can make them feel better. And good firms will do that. There are lots of different ways to do it, but almost every good firm will do that. And look, I think the rise of RIAs has been really healthy. Historically, the brokerage firms did not do a great job for their clients. They just didn't. They sold stuff that was really, really, really expensive. And they probably ended up destroying more value than they did creating it. RIAs tend not to do that. Yeah, right. It starts to look like financial therapy, honestly. I think it is a measure of the fact that we invest in pretty well-run firms that you're not getting a million client questions, right? So the questions tend to be specific to their situation and their family. I don't know if everybody should read it, but we're talking about just having perspective. And so a book I'm finishing right now that I'm enjoying is called Orbital. It's about essentially astronauts in a space station looking back at Earth and just how they think about it. They're all from different countries and different situations, but how they think about how it changes their perspective to literally be off the planet, looking back down, and how that forces you to just think about things differently, which I think is a very healthy exercise for all of us. Feel free on LinkedIn. I speak at conferences occasionally, but I'm an investor and operator in the industry. I'm always around. And look, Matt, right back at you. Love the podcast, what you guys are doing. You were part of a great RIA in its own right, and it's a total pleasure.